Welcome to another episode of the Michael Yardney podcast. Today I want to look into an issue that's causing ripples across the Victorian rental market, actually even beyond too. It's the exodus of landlords. And joining me today is Mike Mortlock, Managing Director of MCG Quantity Surveyors, who recently wrote a detailed report about this. And not surprisingly, the problem isn't just confined to Victoria. In general, many property investors are getting nervous and they're selling up. I also plan to ask him about another issue that could blow up in the face of many property investors, and that's the fact that many are underinsured. So whether you're a property investor, a tenant, simply interested in the dynamics of our housing markets, this is an episode you're not going to want to miss. So let's dive into it and uncover the factors that are driving the exodus of landlords and what it means to the future of our rental markets.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Victoria's rental market's on shaky grounds according to a new report from MCG Quantity Surveyors, which reveals a troubling trend of declining investor activity and in fact a net loss in rental properties. Over the past year, we've seen thousands of rental properties exiting the market, creating a significant supply crunch that's driving up rental prices and making it even harder for tenants, especially those looking for affordable housing. And joining me again today to explore his company report is Mike Mortlock, CEO of MCG Quantity Surveyors, and he's also a board member of PIPA, the Property Investment Professionals of Australia. Hi, Mike.
Hey, Michael, how are you doing?
Good, thank you. Now, I was impressed at the great quantity of reports your firm is putting out. And I guess you get a great broad access to seeing lots of investor activity. As a quantity surveyors, you got insight into what's happening in the Australian housing markets.
Yeah, I suppose there's a two-prong attack for what I like to call MCG research, which is a bit of sort of an internal joke. We're not big enough to have our own research team or economists. There's myself and a couple of people that help me out. But we collect a lot of data ourselves, and we also commission research projects that I like to think kind of tell the story of what's happening in Australia, certainly investor behaviour and the shifting sands. This recent story kind of fits into that second category, but it kind of correlates with data that we're seeing from our own side of the fence as well.
Well, can you maybe start off by summarising the key findings of your recent analysis about the exodus of landlords, particularly from Victoria?
Yeah, Victoria was the real standout when we did this, and we looked at this across the different states. But what we looked at was between mid-April and mid-May, there was a sample of 69,000 residential listings. And what we were looking for was ex-rental properties, so properties that we can see were on the rental market and were selling. So we worked out on an annualised basis that Victoria had 46,000 ex-rental properties for sale. And why I think that's significant, and specifically that was 40,880.
You're a numbers person, aren't you? You had to get that 880 in.
Yeah, sorry.
No, don't apologise. I like it.
No, 40,880 is the ABS data talking about new investors. And in terms of the property selling, it was 45,924. So it's basically a net loss of 5,000 rental properties predicted over the next 12 months. Now, that might not sound like a big amount, but you contrast that with other places like New South Wales, which is going to have a net gain of 9,000, Queensland a net gain of 8,600. It is very, very significant. And Victoria actually, according to the ABS data in the 12 months to September 2023, was the second highest growing population at 2.9%. So the state's getting bigger. It's not losing people to net interstate migration like places like New South Wales is. And the rental market is shrinking. So, you can read between the lines on what that actually means for people renting properties in Victoria.
Well, we're not getting the 10 cities that I've heard happening in Brisbane, but there's long queues and very, very low vacancy rates. Now, interestingly, to put this in context, the latest Australian Bureau of Statistics finance figures came out, and investors are getting back into the market. And interestingly, investor finance is up 31% on 12 months ago. But they're not choosing Victoria, Mike, are they?
They're not choosing Victoria. So what we completed recently was a little bit of a study of what the percentage of people were purchasing in Victoria as distinct from other states pre the land tax announcement and post the land tax announcement. Now, Victoria was already on the slide. There was only around about 8 or 9% of investors particularly choosing Victoria as a state to purchase in. But after the land tax, that actually slumped to about 4.6%. So that is a significant drop from already a low base. And investors are really voting with their feet, where we can see WA has actually overtaken Queensland as the most popular state for investors. So yes, Victoria is on the nose for investors, unfortunately.
Now, we've spoken about it before. Investors should have a long-term focus, and it's understandable that the negative media makes it hard for some people. And I see that as a window of opportunity for those staying in Victoria. But why do you think Victoria is losing more rental properties compared to New South Wales and Queensland? What's going on?
Well, there's a couple of different things at play. People like to see green shoots before they invest. And you can see, in the recent CoreLogic data, the last 2 months, Perth has posted a 2% increase. And, it's already been...
in property values.
Yes. And investors... In capital growth, yes. And investors should, I agree with you, invest counter-cyclically. And I actually think Victoria is a great time to get involved, but they like the comfort of it being on an upward trend. So that's part of it. But I think the main two are the minimum standards legislation. That was probably the first thing that hit Victoria fairly hard. And the word on the street from property managers was that the consultation period and the rollout was very mismanaged. And there's anecdotal stories about huge costs for people to have their investment properties meet those standards, to the point where there are developers that are buying sites that might have an old property on the front, but of course the value is in what they can do in the back. And they might have rented it under the old system, but the cost to bring it up to standard is prohibitive. So we end up with a vacant property, which I think is a bad situation.
Now, we don't want slum landlords, but I agree with you that these minimal standards, yes, we have to have smoke detectors that work and we have to have cooktops that work. No argument about that. But some of the requirements are very expensive, and that together with land tax. I think the other big factor that affects local property markets is the local economy and local consumer confidence. And let's be blunt, the Victorian government is on the nose. Are we going to get political and mention how the former Premier who got us into this position got an Order of Australia or something fancy for the monarch's birthday? So there's a lot of people actually wondering what on earth's going on with the economy in Victoria.
He can't get a golf club membership, but he can get the gong from the Royals. Yeah, look, you mentioned the other big point, and that's the land tax change. And in our data, we've seen that nearly halve the participation rate in Victoria. But yes, the economy doesn't seem to be on a fairly good footing. Of course, Victoria really won the national record of longest lockdown, which is not a title that I think anyone living there at that particular time was happy with, but that was a fairly expensive impost to the government, and the ring of steel and all that sort of stuff. And of course, we've seen
you're bringing back unpleasant memories, Mike.
I know. I'm sorry. I'm putting salt into the wounds. It's still too soon, I think.
Yes. So I read your report. We can't really go through all the postcodes, but I found it interesting that many of the postcodes where investors were exiting were those where there were the newer and the outer suburbs, and ones where there were more apartments. It also shows that some investors probably made poor decisions. We don't really know how long they've actually kept those properties, but they're not in the more established, more affluent suburbs in general.
Yeah, no, that's true. And I guess when you think about the average purchase price people are spending on an investment property, in our latest data, it was $650,000, and you take out the big variables or the outliers. Sometimes we'll have, say, $15 million units in our sample size. You allow for that, and it actually drops down to $550,000. So these are people that I think are purchasing there based on affordability. They don't have that much of a choice. So of course, those people are less likely to be able to weather the storm of increased interest rates, cost of living crisis, inflation, and that sort of stuff. And I always kind of think about that stat of 2.5% own one property. And, really I think that's quite a bad stat for people that are wanting to fundamentally change their financial future. But, of course, purchasing an investment property and having to sell it under duress because of cash flow rather than strategy is a bad situation for people to be in.
Well, I know that during the property boom of 2021, a lot of investors sold up. They'd sat for a while and their properties hadn't gone up, and it was during a rising market. Those selling in Victoria, to be blunt, are not selling in a seller's market. It's a balanced market, but really it's not a period where there's, for secondary properties, long queues of people wanting to buy up. What do you see as the implications for the rental market in Victoria moving forward?
Well, it's a story of supply, right? I mean, all it's really pointing to is that Victoria has made itself a state that doesn't appear to be open for business for property investors. So people have been voting with their feet and purchasing elsewhere. I think 2023 really is a story about affordability, where we saw WA and Queensland leading the charge, and those were much more affordable markets than Melbourne. But of course, that is really kind of changing with Brisbane overtaking the median in Melbourne, and I can't remember that being the case. But yeah, it just speaks to the fact that there's not going to be enough rental supply, and the only way for the vacancy rate in Victoria to go is down.
Well, if you look at that comment you made a moment ago about Brisbane overtaking the median, it depends whose figures you look at, because CoreLogic, and we respect the great information they give us, have a median dwelling price, a median house price, and a median unit price. And in Queensland, there are not as many units, so the median dwelling price is more dominated by houses, and it is that median dwelling price as opposed to the house price that's overtaken. But yes, Victoria currently, the median house price is about 57% of the one in Sydney, compared to, on average, it's been around 70%. In other words, the gap is wider than it's been for many, many decades. I think it was the 1990s, I remember investing then, when there used to be a joke, the last person leaving Victoria, please turn the lights out. But in time, well, actually, I think it was Jeff Kennett came and the government changed, and they put policies in place. And over the long term, the Victorian housing market has slightly outperformed every other of the capital cities. And I think in due course it will revert to the mean again. But can you, maybe putting your Pippa hat on, think of any policy changes or incentives that the Victorian government could implement to either attract new investors or maybe just retain them?
Well, look, this was a question that the Shadow Victorian Housing Minister actually asked a panel at the Pippa breakfast in October, and I think it was Kate Bakos, Stuart Weems and Terry Ryder that were on this panel. And he said, what can be done to incentivise investors? And I think the consensus was investors don't need incentives. They just need the disincentives to be unwound, right? Yes. Because I think
they want certainty, Mike.
Yeah, exactly. And, people should be and are normally in general investing over very, very long time horizons. So changing the rules here and there really removes that certainty and removes that confidence. And I think that's part of the problem. Of course, the land tax has been very onerous. I mean, we saw in our own data when the land tax changes in Queensland were legislated, a 14% drop in investor activity straight away. And that was really we analysed a 98-day period where people could have purchased their in full knowledge that the land tax change was about to happen. Of course, it was ultimately repealed, but that 14% drop over that 98 days, that's significant. It goes to show you're messing around with land tax, and people perhaps disproportionately fear the tax. It's like people going to their accountant saying, I need an investment property, and the accountant says, well, why is that? And they say, well, I'm paying too much tax. And it kind of begs the question, do you care about whether it grows in value or how much it costs you? It's just, I hate the tax, right? And, that's what we're seeing in the data.
Well, I think we both already said that we therefore see a current window of opportunity for those who hang in there if they currently have investments or are wanting to focus in the medium to long term. Now, I actually know only a couple of weeks ago I spoke with a client of Metropole who had a budget that didn't allow other areas. And I said, hey, if you invest in Perth, I bet you Perth will do better than a villa unit in Melbourne over the next year and probably even 2 years' time. But I think over the next 5 years, you're going to find that Melbourne will get back to outperforming, and it's actually, you're going to get, I can't suggest that Sydney's going to do better than Brisbane or Brisbane's going to do better than Melbourne because, in fact, we're not buying the Sydney or the Brisbane market. They'll all do well, but you're going to get a free kick in the short term with the leg up as the Melbourne market catches up again. Then it's just going to revert to the mean of just good long-term capital growth. So I do see a window of opportunity. But Queensland, which is one of the very popular destinations for investment, recently handed down their 2024-25 budget, and they fiddled a bit with property as well. So the governments haven't learned. Now, the budget included an increase in the transfer duty concessions, stamp duty concessions to be blunt, for first home buyers, and I think that's good. It's increased the ceiling from 500,000 to 700,000, and there's even some concessions up to 800,000. So yes, it's encouraging first home buyers in the market, and they're saying this will cost 90 million a year to fund. So how are they going to do it? Well, they very clearly said, we're going to increase taxes on the property industry, that there's going to be additional foreign acquired duties. It's going to be levied at 8%, foreign land tax surcharges raised to 3%, and that's going to actually bring in even more, 4 times as much income as what it's going to cost them for the stamp duty concessions. But they're also going to tax foreign developers more, or any developer that's got more than 50% interest from foreign ownership. And we actually need those to fund developments, to bring developments out of the ground at the moment. So I see this as ending up creating more supply issues at a time when Queensland's got a lot of extra demand, Mike.
Yeah, and I mean, right now at the moment, our annualised kind of dwellings is around about 205,000, 210,000, which is a lot higher than the previous years, but about 30,000 short of what we need. It begs the question, can we afford to pick and choose who the developers are? I don't think we're in a good bargaining position. We're in desperate need of supply, and really who cares who's backing these developers? Of course, it's tremendously popular to kind of tax overseas investors, but I think it's traditionally been quite overstated how much of an influence overseas investors have on the Australian property market. But it's one of the things that's quite popular with the electorate. But I think if we are...
Hey, we're in an election year, Mike.
Yeah, I know. And, isn't it going to be an interesting few months with the lead up to all of the state and federal stuff that we got going on. But honestly, I think the biggest problem we have at the moment is a lack of supply. And if there are foreign developers that are able to solve that problem, I don't know if now is the time to be steering them away.
Well, Queensland needs more homes built fast, and the state government's decision to hit companies that would normally provide some of this doesn't really make a lot of sense. According to the Property Council of Australia, there are no apartments planned for Brisbane beyond next year, and this budget's going to create a gulf even bigger. I'm actually surprised that there aren't other apartments in the pipeline, but according to the Property Council of Australia, the Brisbane apartment market, which is actually a growing market, more and more people are comfortable living in apartments in Brisbane, that's actually going to lead to a very sick housing system.
I think I think some of the developers got burnt because if you cast their mind back, I don't know, what would it be, 6 or 7 years ago, there was actually an oversupply of apartments in Brisbane, and there were stories about, settlements falling over on valuations and people owning properties for 3 or 4 years and getting no capital growth. But I think we need to remember that Queenslanders are still Australians. They might be different, and maybe we fight with them on Origin night or what have you. That's more of a New South Wales, Queensland thing.
Yeah.
I think we are sort of trending towards that higher density, lower maintenance style living. So there's definitely going to be some demand in Queensland for the higher density apartments. But yeah, it's interesting to note that across the board fairly well, those high density projects, the pipeline is quite diminished. And I think it's just so difficult for developers at the moment with high interest rates. Those developments just aren't stacking up as they used to. And there's a number of reasons why that's happening. Of course, we've got a huge infrastructure pipeline that's pulling resources away, labour, construction resources away. That's being unwound to some degree, but there's still a lot going on. There's still rectification from natural disasters that's pulling it away. Construction costs have moderated, but they're still quite high, around about 33% higher than pre-pandemic. So there's a lot of reasons why those projects just aren't stacking. And I know that you and I will kind of agree that a high-rise apartment is not blue-chip investment-grade stock, but what it does do is it brings a lot of supply onto the market very quickly. And if it's people that are just wanting a greater supply to take pressure off the rental market or to get into their first home, then there's opportunities when these blocks of 200 or 400 can just come up straight away out of the ground.
And I have no issue that foreign investors who have a different reason for investing than local investors, I have no issue with them buying it and providing rental accommodation for Aussies who want to or need to live there. So they're not as fussed about capital growth. They're just wanting to get their money out of wherever they're currently living into a safer haven. So no doubt the medium term undersupply is going to continue, which means rents are going to rise. And in due course, we've been through these cycles before, Mike. Eventually, prices will increase of established properties enough to make new properties financially viable. And at that stage, new developments will start coming out of the ground, but they're going to take 3 or 4 years to get there. So no change in sight for a while. Now, Mike, on a different note, according to the Australian Bureau of Statistics, insurance premiums have increased by more than 15% over the past 12 months, well above the CPI level. And the high cost of living is forcing many Australians to cut back on all sorts of things, but interestingly, on property insurance premiums or cancelling them altogether. So I was also interested to read another research report by your firm MCG Quantity Surveyors showing that Australian residential properties in general are very underinsured.
Yeah, and it's something that we've kind of had our finger on the pulse for a while. With the Insurance Council of Australia came out pre-pandemic saying that 81% of properties are underinsured. Now, that was prior to the huge increase in construction costs, so there's been no update on that data, but begs the question, how high could it possibly be? Yes, insurance premiums have risen through the roof, but unfortunately the situation is still quite dire, where we're finding in our data that really a quarter or just under a quarter of properties are underinsured. So unfortunately, I think we focus so much on maximising our portfolio and growth, but we're not adequately protecting those assets as well. And it's easy to kind of think, I'll roll the dice and see what happens, and I don't mind what the insurance figure is. But there is a problem in Australia where people are just relying on these online calculators, and we've completed research that shows a huge variance in those calculators as well. So I think it's really important for people to understand that as they're growing their portfolio, or even if they're just owning their own home, if something was to happen to that property, a lot of people would have to get a tap on the shoulder to say, look, what you've insured this for, we're not going to be able to rebuild this for.
No. So people think, it's going to cost $650,000 to rebuild. I'm just putting up a figure, but I'll only insure it for $500 because if something falls over, it's only going to have a claim of 20, 30, 50, the insurance will pay. But if you have a major claim, the insurance isn't going to give you the whole lot. They'll actually say, hey, you've underinsured, so we're only going to pay a portion of it. Is that the way it works?
Yeah, there's a little known co-insurance clause. So let's say your property is $1 million to rebuild, just for easier numbers, and you've insured it for $800,000. What would actually happen is that they would say, well, you as a homeowner has elected to underinsure your property. Now you've underinsured it to the tune of 20%. So we're only going to give you 80% of your insured amount. So you're only getting 80% of that 800,000. So you're even further away than where you would ideally be. So that's something that not a lot of people are aware of. And most of these reports, in all honesty, we do in the commercial space because commercial insurance is kind of advocated by a broker, right? We're used to residential mortgage brokers, but we don't tend to have residential insurance brokers. So most commercial insurance brokers are aware of that clause. They're aware of the underinsurance problem, and they want to make sure that they're providing they have a duty of care to make sure that not only the insurance is fit for purpose, but it's the correct insured amount. But in the residential space, there's just not that level of protection and awareness about the problem.
Now, let's make it clear, neither of us are qualified to give insurance advice, so we believe you should go to a good broker to do this rather than getting the information online. Having said that, MCG quantity surveyors, as quantity surveyors, where quantity surveyors initially came from was surveying quantities, working out what it costs to put a building together, and I know that's part of the work you do at MCG quantity surveyors, so you've got a good understanding of that. But what else do your firm do, and how can you help property investors, Mike?
Yeah, look, I guess our kind of catchphrase is maximise and protect, and that speaks to two of our major services. One is the tax depreciation schedules, where of course it's our job to identify the decline in value over time and apply the statutory rates of depreciation the ATO give us to enable us to minimise our tax as investors. The other side, of course, the protection piece is the insurance replacement cost estimates that we do, so we can actually say this is the cost it would take to rebuild this property. And it's not just the construction costs, it's things like demolition, it's cost escalations, it's tendering, it's compliance in and around what was built there before might not be able to be built in the current planning laws. And outside of that, it's any reason you might want to know how much it costs to build something, from a feasibility, from a development, or it might be a legal dispute, or it could be a financier that's wanting to release funds based on works fixed to site. That's the sort of the broad spectrum of work that we do.
Well, I would suggest anybody who owns an apartment and is part of an owners corporation, body corporate, should actually get their body corporate managers to go to MCG quantity surveyors and get an update of what would cost to replace the building, because you're probably going to get a shock, because the cost of building apartments has got risen proportionately considerably more than the cost of building a home, Mike.
And in tandem with that as well, what traditionally was understood to be sinking funds or capital works funds, we provide those reports as well. So it's not just making sure that it's insured to the point that it can be rebuilt and there's no shortfall, but it's also understanding the ongoing maintenance requirements, because there is a temptation with owners to try and minimise their strata fees. Of course, it kind of just feels like there's money flying out of your pocket, but you do need to make sure that you're not exposing yourself to those special levies, because if something does need to be replaced or repaired and there's not enough money in the kitty, well then it's a whip round, and some of those numbers can be quite frightening.
Definitely they can. So I'll leave a link to MCG Quantity Surveyors in the show notes. And by the way, just want to make it clear, even though I've mentioned your firm a couple of times, this is not a paid sponsorship. In fact, when I have a quantity surveying report, I pay for it. Your firm does a great job for me personally, so I'm not asking for any favours. Similarly, we refer a lot of our clients to them. But the other thing is, you've also been very kind in previous years, and you're doing it again this year. Your firm is very generous, and I know you're sponsoring the Metropole charity ball. You're coming along with your team. And interestingly, that's nothing about Metropole. It's actually about very special kids. So I'm looking forward to catching up with you and your team in August about that. But more importantly, thank you for your chat today. And I really look forward to catching up with you again and talking property real soon.
Yeah, thanks for having me. We always have fun and tackle the big issues. We'll see you next time.
Yeah. I always enjoy my chats with Mike Mortlock, who brings great perspective into what's happening in the housing markets. If you enjoyed it also, and you don't currently subscribe or follow this show, whichever podcast app you're listening to this on, and I know a lot of people listen to this on YouTube, a huge number of people listen to the audio only on YouTube, fantastic. Just stop for a second, subscribe or follow so that twice a week you get the advice and information from my guests and myself. And I guess you also heard that while in general some investors are concerned, some are exiting the market, we see this as a window of opportunity. So I don't know about you. Have you been worrying about what's ahead for our property markets? I'm still hearing people worrying that other investors are exiting the market. So, maybe the timing is wrong, but you know that you shouldn't follow the herd. Others are worried that inflation's remaining stubbornly high, meaning interest rates aren't going to fall anytime soon. Yet others are finding it a bit harder with the banks. So these potential property investors and home buyers, they're just sitting on the sidelines waiting for all the signs to improve before they make the move into property. On the other hand, we're seeing more and more investors at Metropole, strategic investors, taking a long-term view. They're not worried where interest rates are going to be or where the economy is going to be in 6 months' time. They're making their plans based on where housing markets will be in 5 or 10 years' time. So they realise that the property markets reset early last year, and now they've been rising for 1.5 years, which means that the severe shortage of properties and the rising rents that we talked about in the show with Mike are not going away anytime soon. So maybe that's why we've had more investors and home buyers engaging our services at Metropole in the last couple of months than we've had for a long, long time. I guess they realise we're much more than just another buyer's agent. At Metropole, we safely help our clients create intergenerational wealth through property. And while we're big enough to tip the scales in your favour, we're still small enough to care. So why not go to metropole.com.au and organise a complimentary chat with one of our wealth strategists at Metropole to explore your options. Now, I'm not suggesting there aren't going to be challenges ahead for our economy and our housing markets. There will be, but we know where the landmines are. We've been there before, and we're going to be able to help you. So go to metropole.com.au and have a complimentary wealth discovery chat with our team to explore your options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message with you today, I'd like to ask you, do you need to empty your cup before you can grow? Look, you've probably heard about it, but let me repeat this old Zen parable that I love. A professor comes to visit an old Zen master to seek advice. "I've come to ask you to teach me about Zen," the professor said. As the master begins to teach, the professor repeatedly interrupts him and shares his own opinions, knowledge and stories. So the Zen master suggested the two should just take a break and have a cup of tea, have some tea. The master poured the professor a cup. Once it was full, he kept pouring until the cup overflowed, hot tea all over the table, onto the floor and onto the professor's robes. "Stop," cried the professor. "Can't you see the cup's already full?" "Precisely," said the Zen master. "You're like this cup, so full of ideas that nothing more will fit. Come back to me with an empty cup." Now, this parable is a reminder that we can't hope to embrace new information or insights if our cup is too full of preconceived ideas, assumptions and beliefs. So if your cup is too full to embrace new information that the world is giving you, what are you going to do about it? Do you need to empty your cup before you can grow? Something to think about. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group. Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?